how to value a company is a fine art, and in some ways the calculations become even more fiendish when it comes to assessing the merits of an entire index or country. Yes, you can still look at price to earnings, price to book or dividend yield ratios when it comes to countries, but a discounted cash flow model or DCF is not practical. And then there's still the fuss of adding up all the data, a job so time consuming few of us would even bother to think about it. That's why market capitalisation to GDP, or the total stock market value of all listed companies relative to the size of a nation's economy, can be a useful rule of thumb to decide whether a market is expensive or not. And it's very interesting right now with regards to the UK in particular. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this week's edition of Breaking the Mould, I'm here to look at the valuation of UK listed shares in total to see if there's anything investors need to be aware of, especially in light of a study by consultants McKinsey on the outlook for global corporate earnings. Now, the key chart is this one. It shows the UK stock market's valuation as a percentage of GDP over time, back to the 1980s. The £2.2 trillion price tag currently represents just over 120% of GDP. That's high by historic standards, again at least dating back to the late 80s, but stands marginally below the 133% peak that we saw in 2000. Now, so far to be fair, just a little bit worrying, as it suggests UK stocks may be expensive relative to their own history. But it is possible to justify this on the grounds that British firms have never been more profitable. Corporate income equates to 5.9% of GDP against a post-1988 average of 4.9%, according to statistics from the ONS. Now, we all know the past is no guarantee at all for the future, although the tumble in corporate profits around the turn of the century may help to explain the bear market of 2000 to 2003, and that in turn suggests profits may have to stay high to help keep the market high right now. This is where the intriguing analysis from McKinsey comes in. They assert that on a global, not just a UK basis, corporate profits have surged from 7.8% of GDP in 1980 to 9.8%, an all-time high, helped by lower corporate tax rates, the availability of cheaper labour in emerging economies, and strong demand from emerging economies, helped by example by the collapse of the USSR, the rise of China, India and so on. McKinsey now fears those tailwinds will become headwinds. Corporate tax rates may start to rise, and this does make sense, and in some ways in an era of austerity when many politicians and members of the public are calling for the economic pie to be shared in a different way. Labour, employees may become more expensive as the minimum or living wages rise in developed and emerging economies alike. The internet continues to act as a huge deflationary force, with the rise of price comparison sites just one facet of this. And finally, emerging economies develop their own industries which look to build an established position on the global stage, and McKinsey argue they might always be obsessed with profit and are more interested in employing people because they're state controlled. Now, the net result is McKinsey believes corporate profits as a percentage of GDP worldwide will drop in the coming decade out to 2025, even if the total profit pool rises. This next graphic shows corporate income in trillions of dollars, the bars, and as a percentage of GDP, the line. Note how the bulk of the last 30 years' gains disappear on the line, and that the implication of the bars is the compound annual growth rate in profits slips from 4% a year to just 1.8% in the coming decade. Now, this is in no way guaranteed to be right or mean that markets are set for a fall, but it does suggest investors in the UK need at least to be aware of the market's overall valuation in this context, and also which industries could thrive and which could fall by the wayside in the environment outlined by the McKinsey analysis. The consultants look towards idea-intensive industries as potential winners, those where intellectual property is a potential differentiator and barrier to entry, and capital-intensive, labour-intensive manufacturing areas as potential losers. Let's see if they're right, and thank you for watching.